This line here shows something known as Bitcoin's electrical cost, which represents the average cost of electricity required to mine a single Bitcoin. If we put Bitcoin's price on top, we see that over the past decade, Bitcoin has consistently traded above its electrical cost. There have been only 2 instances where Bitcoin actually fell to this level. The first was in 2018, following China's crackdown on the crypto market. The second occurred in 2020, during the pandemic-driven market collapse. In the other instances where price approached this line, it wasn't because Bitcoin declined, but because the electrical cost itself moved higher. And this makes sense. Electricity is the foundational input for mining Bitcoin, which naturally establishes a lower boundary for its production economics. Today, that electrical cost sits at around $62,000, and while this level will adjust over time as energy prices change, it provides a useful reference point for downside risk. From our perspective, reaching this level would represent a worst-case scenario, one that would likely require a significant negative catalyst, but we don't see any such catalyst present at the moment. Now, while electrical cost gives us a worst-case baseline, mining Bitcoin involves far more than just electricity. Hardware costs, cooling infrastructure, maintenance, and operational overhead all play an essential role. That brings us to the second method, known as Bitcoin's production cost. This line shows us the average production cost of Bitcoin. When we overlay Bitcoin's price, a clear pattern emerges. Periods where Bitcoin fell down to its production cost, or briefly dipped below it, have historically marked some of the most attractive long-term buying opportunities. That's because at those levels, weak miners capitulate, forced selling pressure peaks, and the market clears out the excess leverage. Today, Bitcoin's production cost sits at roughly $78,000. Hypothetically, a move down to that level would mean about a 15% decline for Bitcoin from its current level. And while that's possible, it would likely require a broader market pullback, especially given that Bitcoin has already corrected by 35% over the 3 months. But there is one additional factor to consider that makes this cycle different from prior ones, and that's where the third method comes in, which also takes into account Bitcoin ETFs that were introduced in 2024. If we look at the average cost of Bitcoin held by ETFs and put Bitcoin's price on top, the importance of this method becomes clear. During the mid-2024 correction and the early 2025 correction, when Bitcoin pulled back near its average ETF cost, buyers consistently stepped in and were able to eventually push price higher. This makes sense because the average ETF cost represents the region where a large amount of demand was previously established. When price pulls back towards that region, it often attracts additional buying rather than selling. Today, the average ETF cost is about $87,000, a level that Bitcoin has been holding above despite the recent correction. In fact, Bitcoin is showing signs of stabilizing, suggesting that ETF demand is once again providing support.